Not even Jerome Powell can crash this market, so bears, you've got some serious work to do. He came off far more hawkish than I was anticipating, and still, the market did not break key support. If we looked strictly at the technicals, everything still aligns with the bullish base case, except for three not-so-subtle data points. Google, Apple, Tesla all had pretty rough days. But even if markets do continue to pull back, a reasonable higher low can still be set. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight on the SPY daily time frame chart, and let's start with the basics. What's going on here from a trend perspective? Of course, the base case tells us that we have lows, we have higher lows. This is a soft higher low on the unfilled gap. This is another soft higher low. The hourly trend never flipped it down. And I would start considering this, the low of today's session, another potential soft higher low. If we're thinking about the hourly trend in this box right here, it's been much more of a balance range than an actual downtrend that's developed. I mean, the market gapped down on the Tuesday morning session. It closed the gap and then closed weak, but it never actually broke down underneath this previous low from here. On today's session, during the peak of the FOMC fear, if you will, towards the low of day, we undercut the low by just a hair, but I would not classify this as an hourly downtrend. It's just a balance. So what does that leave us with in terms of the daily trend? Well, it's certainly still in the upward direction. And if this is a soft higher low, if we do ultimately break down with some acceptance underneath 558 on the daily time frame, as we talked about on Saturday, that's not really a concern. If the hourly trend flips to down, that's fine. We know that the daily trend can satisfy a higher low anywhere over the top end of the tariff turmoil zone, which is here at 546.75. It would be even better if the previous weekly area of support, if we just zoom out a little bit, this previous shelf of support, which is very close to the 90-day pause high. If we could use that as support, the level is technically 551, that would be ideal as well, but it would require the hourly trend to flip to down, breaking down underneath today's low of day with some degree of acceptance. Now, if we just analyze today's daily bar structure, does it look all that convincing that big new money sellers are stepping up here? Absolutely not. It's a hammer-esque style bar where you can see that we undercut the low of Tuesday by just a hair and still closed inside of Tuesday's range. Now, I'm not going to sit here and say that we closed the most phenomenal bar over Tuesday's high. That's certainly not the case. But as we're just evaluating, do we have stronger sellers or do we have stronger buyers getting involved in the market? Certainly don't have stronger sellers. I wouldn't argue that we have strong buyers, but the trend is up. So who has the burden of proof? It's absolutely the sellers at this point in time. So the daily trend remains intact. It's bullish here. If we do look for upside targets into the end of the week, remember that this zone in here is certainly worth respecting. We have our daily 200 SMA tangled up in between the key levels at 569.75 and 575.50. I certainly would still use that as an area of resistance if the market breaks the 2 equal highs here and makes a move in the upward direction. I'd be thinking about taking profits towards this area rather than initiating new long positions as we're testing the daily 200 for the first time in a while. The last time we tested it, you could see it acted as resistance back here. We would also be approaching the upper edge of the weekly expected move. So don't get me wrong, it's still bullish. We're looking at a bullish trend here, but as we approach that zone, it's probably worth selling into the next highest high, right? If we're thinking about the trend count we have along the ways. I know we were talking about the lows, but we have highs, equal highs, equal highs, equal highs, finally getting some higher highs. This is the highest high in the trend count. A new higher high in the trend count near the daily 200 might be a good place to button up some longs, take some risk off the table, take profit on those longs, and then evaluate for another possible higher low pullback if that's coming around the corner. If we do just get straight up continuation through that zone, the next major area of resistance overhead, I know there's a lot of lines on here, and it's because the previous volatility was not nearly as wide as this, so they look really tight together, but they're not. The next big zone overhead comes from this balance range. This is really what I would focus on at 590.25. That's the next major spot to test in the upward direction if this market just gets straight up continuation. Now, one thing I also want to talk about and draw the comparison to, as we did in the weekend update, was as the V-shaped recovery unfolded from the August 5th yen carry trade explosion, Remember that the market went sideways and balanced off for a little bit. Now, think about what we just talked about. The market is in a balance range for the last 5 sessions here between 558 and the top end of that zone closer to about 566.25. If this is going to be similar, once again, it's not unreasonable that the market balances off, some kind of news drops the market from the balance range. When we get to 551, when we get to 546.75, that is where I'm looking for this equivalent higher low. And that would be a firm higher low at that point, requiring the hourly trend to break down. So speaking of the hourly, let's go there now and let's take a look at how potentially this unfolds. So the first thing I would argue, is that sellers did not capitalize on the small bit of momentum that they had in the afternoon. If you're thinking about a pattern perspective here, we've been talking about how perhaps this was a Man Ray pattern, basically a double top with left and right shoulders. So your neckline here was technically broken on the peak fear of FOMC, but the question remains, did we close below the level? Was there an hourly lower high below the level? And the answer is no. So what remains is just an hourly balance range in this area right here. And if we remain inside of the balance, then, good luck making really clean trades inside of the zone. I think we're really dealing with a tight, compressed range in the market. Perhaps there's Brigade bolts outside of 562, trade up into 566.25. We can look for that. If we get follow through from that, right over 566.25, trades up into that 569.75 zone that we were just talking about. We can walk these levels up, that's fine, but just understand that the hourly trend is certainly not favorable here for big continuation longs. We would need to see the first stage of that via some sort of Brigade bolt over 562. Now, just a moment ago on the daily time frame chart, I was talking about how the hourly trend would inherently break to down if we were going to make a move for the daily higher low pullback into this zone here. And you can clearly see how that's still the case. If the market makes a move underneath 558 and produces a lower high here, I would be thinking about how can I participate short, trade-wise, for risk and reward into this daily higher low zone, which is really here between 551 and 546.75. And when we get there, so the trade may look something like this. Here's your Brigade bolt under the level. Let's say then we get a reversal that looks like this. I would be all aboard the long train on the hourly reversal of trend via some sort of this, particular examples in inverted head and shoulders. It could be a double bottom. It could look like a higher low double bottom where the market does something like this, right? Back above the level here. I would start thinking about the hourly trend reversal in the upward direction as being more advantageous to take advantage of the daily higher low, the DHL shipment, as we call it here on the channel. So that's the analysis that I'm seeing thus far. There's no evidence that stronger sellers are really trying to run away with the market. Again, not even Jerome Powell could crash the market here this afternoon. And so far, we remain inside of an hourly balance. So the immediate trades that come to mind for tomorrow's session would look something like Brigade bolt over 562. If the market balances off in here, maybe it sets up a Friday move that looks like this. And then early next week, we can look for some sort of response from the buyers towards this zone that we've been going on and on about. If the market's going to impress me and just break out of the balance range in the upward direction, once again, I would want the early entries trying for risk reward like this to get to the top of the range. If we end up opening on a gap up tomorrow or into the end of the week Friday, it just gets a little bit harder to put on new money longs on a gap up here towards the top end of a balance range. You're basically buying into resistance, right? That's not really, in theory, how you would want to participate in that particular trade. Let's go ahead and zoom out a little bit. Let's take a look at our Fibonacci's from the bottom of the most recent move. This is the last major higher low in the trend count to the highest high. We can see that this does not change, right? The Fib 38.2 is tangled up right at our line in the sand, which is 546.75, the top end of the tariff turmoil zone. That is still intact. If we clear that up, I suppose the next one we could look at is really from last Wednesday up to the high. Notice that the Fib 38.2 is technically holding here, and so long as consolidation is above that, I would still, from a Fib perspective, have to give the benefit of the doubt to the buyers in this market. We can check in on our anchored view apps intraday. There's really no new major anchor points here. Just continue to understand that this entire band, the cluster underneath us, is supportive of this zone acting as an ideal daily higher low. Let's take a look at our market internals. If you're not familiar with this dashboard, take a look at the video tutorial in the top right-hand corner. Generally, the question we're trying to answer on this screen is, do we have strong participants on either side of the market? And let's just start by saying the market did absolutely pull back this week, right? We've pulled back from Friday's high. So Saturday's video is kind of spot on in the sense that, like, don't long that up there towards the tippity top of the move. But the question becomes, okay, the market moved lower. Do we see stronger sellers pushing the market lower, or is this just a corrective pullback? Well, I don't know about you, but looking at the volume flows for the week, Definitely not stronger sellers there. The actual ratios intraday have never been aggressive on the downside. If we look at the advanced decline line, it opens lower on Monday. That's a little bit of a cause for concern, but it certainly rallies higher to close out, or spend a majority of the day, I should say, near the zero line. Same thing here on Tuesday. Wednesday, we're over the zero line all day as the market continues to pull back and remain in turmoil. A little bit more of a bearish build out of the cumulative build, but it's not a straight shot 45-degree, detrimental negative 6,000 print into the close. Tuesday's a mixed bag, as is today's Wednesday session. So again, going back to that core question, as the market's pulled back here, are stronger sellers the one causing that, or is it more so just corrective action, profit taking, and some reluctant bulls to step in at the highest high? I certainly think that it's the latter, certainly not the former, with no stronger sellers evident at the exchange level. Let's take a look at the market profile. If you're not familiar with the profile, take a look at the video tutorial in the top right-hand corner. The big call out here is just that value has progressively moved lower once, twice, and now it's actually overlapping, right? So even though the market felt like it was lower today on the session, value was unchanged. Point of control is hardly changed here. And you actually have a really strong excess low in J period, which would indicate that the auction ended properly. Now, we do have an M period spike, and as of right now, the post market is currently trading around this 56.38. It seems as though we're opening underneath the M period spike. So spike rules would tell us, right, that we want to look for the top of the spike. We want to look for the base of the spike. If the market opens over the spike, that's the most bullish outcome. We should expect the auction to continue. If we open in the spike, we learn something when we test the high. We learn something when we test the base. Opening under the spike is the biggest sign of price rejection, right? So this is a subtle bearish data point here among the analysis. I wouldn't call it the end of the world because, as we've talked about on the Spider's daily time frame chart, right, even breakdowns of this zone, which is really closer to about 5,600 on the ES futures, if we break below that, there's still room for a daily higher low. The ES futures level is 55.25. We talk about that every morning in the pre-market prep, right? It's live every morning at 8 o'clock. If you don't come out to those shows, then I would recommend you do. So anyhow, market profile currently indicating a rejection of these spike prices, being slightly more bearish. I would be neutral if we open in range in value. It's another day of potential chop as we ultimately deal with, as we said on the hourly time frame, just a balance range. The market's not trending cleanly on the hourly time scale. Let's jump back on over to the platform here. Let's take a look at our good friend, the QQQ NASDAQ 100. Start with the daily time frame chart, and we'll work our way lower from there. So just like the S&P, the narrative is almost the same in the sense that we have pulled back from the daily 200. The S&P didn't quite make it all the way there. Nonetheless, you've pulled back from the 200. What I find a little bit more compelling about the NASDAQ is that the gap actually closed and offered more of a reversal off the low here. Recall that on the Thursday gap up, we did not close that gap all the way. We talked about this on Saturday. The gap fill reversal was a reasonable place to get long, and you can see that market participants did indeed get long off the gap fill reversal, lower edge of the weekly expected move, close to about 477. The daily structure here is certainly hammer-esque in nature. I would start classifying this as a little bit more of a clean, bullish response to a bull flag here on the QQQ daily as compared to the S&P, which was a little bit more balanced. Now, another thing that you could just read into is the fact that the NASDAQ did break more firmly underneath that candle's low, the Thursday low of last week, whereas the S&P has just been flirting with it, right? So you did flip into a technical hourly downtrend here, especially with the lower high on Tuesday being clean underneath the low from the Monday session. So all things considered, the hourly or the daily trend, on the NASDAQ is still lows. Higher lows happening here. This is a soft higher low. This is a soft higher low. This could honestly start acting as a firm higher low over 477 should prices remain above that level. I wouldn't be deterred if prices break below and come into this 465.85 because it's still inherently a higher low well above the last major higher low in the trend count here, and it's sort of an equal low on par with the last soft higher low in the trend count that we have here anyhow from Wednesday of last week. So the daily timescale, still bullish, bulls on parade. There's really no threat of a daily trend reversal here that I can see yet, as long as we're over this 465.85 on the QQQ. Any breaks up and over this 485 flat, probably looking for a retest of your daily 200 SMA and the local highs here closer to 493. Continuation over that, your major level above, just like we talked about on the S&P 500, comes from this balance range back up here. Lots of overhead supply, right? That level's at 510. 510. Not calling for that into the end of the week. Again, anything can happen. It's always the nature of the market. We have to understand that as traders. Certainly lower probabilities of that. However, that's the number, right? 510 represents the bottom of this balance from back over here. Again, reasonable target to the end of the week, probably more like 493 equal highs, and then maybe breaking closer to about the 502.50s. 502.75 coming from this previous pivot back here. So those are your numbers overhead. Let's get down to the hourly though. Let's get a little bit more nuanced. Let's take a look. So once again, you can see here on the hourly, instead of calling this a balance, there is definitively a lower low on the gap down from Tuesday's open. There is definitively, here's a high, here's a lower high. It's technically in range though, right? So this is an in range lower high. This is a below range lower high, and this inherently is another lower low. So the hourly trend did actually flip to down here on the QQQ. You can see if we were to draw in, let's try something like this, a similar pattern, right? You're sort of underneath the neckline into the lows of this afternoon. So with that, the hourly trend did flip to down. Here's the full gap close as well at the 477. You can see that this range is maybe a little bit sloppy, and the best trades here for the NASDAQ probably revolve around some sort of move that either comes back down and tests and holds 477 again, risk and reward back to the upside, or Brigade bolts over 485 to retarget that daily 200 as we were just talking about for risk and reward back to the upside like that into the remainder of the week. Any consolidation that then persists up here is a building block in the upward direction, right? This could then be construed as a daily range, then follow through over your 493 gets you to that 502.75 that we were just talking about moments ago. If we come in here and talk about the bear case, right? Where do the bears really come out and start roaring? I mean, perhaps on a Brigade bolt here under 477, we come into the daily retest of that 465.85, in which, in the circumstances of doing that, just like the S&P, I would still be open-minded to and looking for optimistic about a daily higher low here. The only time where I really reevaluate the base case, and you could say, oh, he's flip-flopping again, that's fine. The only time where I really, truly reevaluate the base case, is this still bullish, is if the daily trend ends up doing something along these lines. A lower high underneath 465.85 would start to really question the true strength of the buyers. But if we're looking for more evidence, more data points as to, okay, is this bullish, is this bearish? Let's take a look at the Fibonacci's here coming from our last major low up to the high. You can see that the Fib 38.2 is right there, so all set, reinforcing that 465.85 from this low up to the high. You can see that we did test a little bit below the 38.2, but for the most part, this price acceptance, if you look at those candle bodies, they are mostly over the Fib 38.2. The 61.8 is confluence with this level. We had around 473 here in the market, daily 50 SMA in the QQQ as well. Final check would be our anchored view apps on the intraday. Let's have ourselves a little look here. And once again, just supportive of the thesis that as long as we're above this cluster, the buyers are probably the ones in the driver's seat, and the burden of proof is absolutely on the sellers right now. Let's take a look at the NASDAQ market internals. See if we can learn anything different about the NASDAQ. The answer, fortunately or unfortunately, if you're a bear, is no. You don't really have substantial volume outflows on any of these sessions breaching underneath negative 400 million. You're definitely not as close to the zero line out of the advanced decline line, but we know that the hourly trend actually flipped to down here. So it's more reasonable that you'd have more bearish evidence in the market internals for the NASDAQ. It's just not overwhelming enough where I would say, oh my God, this is a toxic market. You should not touch this on the long side. You should probably be thinking about shorts. It's divergent. You're not there. You're not seeing that big, bold aggression from the sellers. Same thing here out of the cumulative builds in the tick itself. Let's take a look at the NQ market profile. A little funky zoom here. Let's see if we can't reset that a little bit. Prettier on the eyes. There we go. Not bad. So what's going on with value and point of control? Here is value from Tuesday. Here's today's FOMC value. Point of control is mildly lower. Value is overlapping to slightly down. I would just make the same argument about the spike rules being in play here and the main focus as we head into the Thursday, Friday session. How does the end of the week end, literally, relative to this M period spike? I mean, it was a pretty aggressive buy up into the close today after Powell was done speaking. To see that we're already underneath that leads me to believe it wouldn't be unreasonable, right, for further balance inside of these two-day ranges, ultimately, if not maybe some small continued pullback, in which case I would still be thinking about those higher lows that we've already outlined on the daily trends. So be it up, be it down, I don't think that the bears have a strong enough foothold right now in the market to aggressively change the trend back to down. Let's move back on over to the platform and finish up the third index here. Let's go on over to the IWM. Let's reset this actually to the dailies. Here we go. And small caps, Not really all that favorable. I would say that it's still a mild pullback. It's not aggressive. The thing that I'm just still trying to resolve in terms of tension of the time frames is the weekly big threat. Right? It's even more than a weekly threat. It's really a monthly threat. It's a multi-year balance range high. If we do something that looks like that, we've been talking about this level for quite a long time in here. Call it 198, call it 200. It's your weekly 200 SMA. It's exactly where an ideal lower high would form if small caps are going to roll back over and retest the bottom end of their range from here after the big tariff turmoil plunged to the downside, basically. So trying to resolve this time frame and the tension that we see here on the daily, because the daily trend is certainly up. Don't get it twisted. We have lows, we have higher lows. This is a soft higher low. This is maybe starting to become a little bit more of a firm higher low. You're stair-stepping higher with highs, higher highs, and higher highs in the short-term trend count, but that weekly lower high is still the threat. Weekly 200 SMA, daily 50 SMA is wrapped up in here as well. I'm just not fully convinced that we're out of the woods when it comes to small caps. The one thing I will say is just the response to Jerome Powell here is actually one of the stronger of the bars. We never saw a test of that Tuesday low. Even in peak FOMC fear, there was no test below that 195.15. So is it really all that bearish? No, but is the higher time frame lower high still available? Yes. So that's the tension that's here. You can hear it probably in my voice, trying to think about these things at the same time. Doesn't really give you a lot, or it doesn't give me, I'll speak for myself, maybe it gives you a ton of confidence. It doesn't give me a ton of confidence one way or another to say that the IWM is an influencing factor right now over the S&P 500. With that, I mean, we'll continue to trade this at face value, don't get me wrong, in uptrends and uptrends and uptrend. As long as we're over 195.15, we'll call a spade, and fine. If we Brigade bolt back over 198.25, we look for the equal high relative to last Friday, and then beyond that, this major pivot up here around 202.75. At that point, I would probably just start thinking about this entire zone as a possible zone of rejections for small caps on the weekly time frame. So if you notice that the market opens in IWM tomorrow underneath 198.25, tests in range, rejects and closes back below, Friday maybe closes back below as well, it's one of those slightly more bearish indications. Even though the trend is up, we're trying to balance that off with a weekly higher time frame downtrend that is still very clear for a threat at 200. Let's drop it on down to the hourly time scale. See what else we can learn. This is, just much cleaner price acceptance underneath the 2-day range here. Now we have a 2-day range here. That's clearly a stair step in the downward direction with a clean neckline back below that 195.15. So I'll still read into the idea that the market was unable to break the previous day's low during the Jerome Powell volatility, but it also didn't really make this big spike into the settlement either, right? You could read into it both ways. The other two indices did make that end of day spike. The IWM certainly did not. So really just treating it as range bound and literally day by day in small caps at this 198.25, 195.15 opens up the possibility for stronger downside and just a straight up rejection for the weekly lower high. If you're over the 198.25, understand that the weekly close of the bar is going to be very important relative to this number right here, 198.25. So carry that forward. Okay, let's quickly check in just to be congruent on our good old Fibonacci's from the low of this move up to the high. That is the last major higher low in the trend count, hourly downtrend here via the lower low, right? So we're still well above the Fib 38.2. I would say that pullbacks in theory could still accept above that. I'm always a fan of rank ordering these things such that price action levels are always number one, and then supporting evidence beyond that, such as Fibs or anchored VWAPs or whatever, are always secondary. So am I going to be waiting for this Fib 38.2 and still being bullish down here? No, not on the technical break of 195.15. So let's take that off. Let's come in from this low up to the most recent high. And you can see that the Fib 68.1 is stacked right at the 195.15. That to me is a little bit more compelling to suggest if we can stay over that, it's the line in the sand from a Fib perspective. That's as deep as a pullback can possibly get before we say, okay, this is unreasonable. You're expecting a 100% retracement, a failed trend in one direction, and likely follow through underneath. In this case, that would be possible gap close down below and a failure to hold up over the top end of the 90-day pause high. If we check in on our anchored VWAPs, once again to be congruent, we're above the entire stack, but notice how we're already testing the top end of the stack rather than the S&P and the NASDAQ, which is waiting to support us underneath. The IWM is already there. So we'll say bullish until proven otherwise on the smaller time frames, but on the higher time frames, not totally sold on the idea that buyers are in the driver's seat in small caps here. Let's look at the Russell internals. Do we have any substantial volume outflows? No, we don't. So again, still giving the buyers the benefit of the doubt. Same thing here at the zero mark and trending higher through the session on Tuesday over the zero mark today. Cumulative builds very mild. Certainly, we don't have strong sellers, right? We could frame it that way. It's not like there's a big sharp weekly rejection of that 200 figure and oh my God, the Russell fell off of a cliff. It's more of a mild sort of balance that's unfolding here and just new money buyers not really suggesting that they have the appetite to step up and buy small caps at this level. If we take a look at our good friend, the market profile, to finish up small caps here, what do we see? Let's zoom out a little bit so we can see a couple of days back to back here, something along these lines. Can we get one more? There we go. What we're looking at is a value area and point of control that's slightly higher. That's different than what we saw in the S&P and the NASDAQ. What else is different is poor high, poor low. So expecting any tests of previous day high, previous day low to offer a break through that zone. I would prefer, right, to help the bull case on the S&P that the small caps would break and Brigade bolt over previous day's high, but it's just as susceptible on the low. You do not have a nice J period excess low there like we did in the S&P and the NASDAQ. Let's get into our sectors here as we're about halfway through tonight's episode. Let's see what the sectors are telling us. First, let's begin with the weekly performance and who was leading, who was losing, and where was the weight. Utilities lead the pack here this week, up 1.59%. As the market pulls back, that's exactly indicative of the rotation thesis we talked about on Saturday, right? Remember, a healthy market rotates between its sectors. A not so healthy market is overcorrelated and everything is up, everything's down. It's volatile, swinging higher, swinging lower, all over the place. So XLU leading the pack is indicative of a rotation. If we look at semiconductors, they're up second. It's not technically a sector, but that's definitely leaning more risk on than risk off. Underneath that, we have communications. At the bottom three, we have the healthcare sector, that's defensive. We have materials, and then we have real estate. So really not, as the pullback is very, very gentle and mild here, not indicative of like everybody throwing in the towel and just selling all these heavyweight risk on assets. It's not the case. If we look at the structural charts, utilities is starting to break out. This is exactly what we talked about last Saturday. Again, I think that this rotation thesis is healthy for the market. It's more bullish for the market, at least continuing its structural advance here, rather than just V-shaped snap your neck recovery straight back to all-time highs. If we look at the semiconductors, I think this also looks very constructive. We gapped down on the Tuesday session, but we stayed over this 212. As we said on Saturday, if this higher low can persist, the next Brigade bolt is here. Bring me to 230. That's going to help fuel the market higher in a risk-on way to possibly end out the week. We'll see if we can get some follow-through through these equal highs at 219.50. XLC Communications, with Google, of course, having an abysmal session. This is really not a bad close considering what happened at the sector level here. If you do see a continued pullback, 95 can still offer that higher low. So just like we talked about on the S&P index, it's really not a threat of a trend change at the sector level. So we look at the TLT, the long bond here, a little bit of a gap up on today's session, which is slightly lower on interest rates, but generally speaking, the Fed did not cause much rate volatility, bond volatility. One more time, I think that the reduction of bond volatility is good for this market considering all of the turmoil that we went through in this with the whiplash in rates. That's going to scare away foreign investors, people looking to more so secure capital in the bond market, at least here in the US, rather than, the volatility is going to scare them away rather than bring them back, right? So I like that rates are slowing down in terms of the pace of their movement. That is healthy. If we look at the XLK, I do like the consolidation that's high and tight. I like the gap into the gap. Notice this is on, as we get this zoom proper, there we go. The gap into the gap, excuse me, on Tuesday, double stream today has got me a little bit, got the voice box all worn out. We've got the gap into the gap, and the seller's unable to follow through to the downside to close the original gap. This is the gap up here. There's too many gaps. And then on today's session, we did end up closing back inside of Monday's range, which is more impressive. Closing in Monday's range over Tuesday's high. It's just a lack of sell-side aggression to close what is fairly thin structure, right? Stronger sellers should have had no issue rotating through that, and it just didn't happen. So let's move along to the XLF and see what's going on from financials. Really high and tight consolidation. It's fine. Higher low pullbacks over 48.65 are great. I would even say if you take it one step further, this is that same concept of a soft higher low. If the hourly trend actually builds out something that looks like this, I would still be bullish financials so long as we're over the top end of the 90-day pause at 47.60. XLV Healthcare is not looking so hot on a look above and fail. Technically speaking, on the range, we should target the bottom end here based on the pattern. That would be 131.75. This is a heavier weight sector for the S&P, but as we know, it is technically D for defensive. So is it the end of the world? I think the answer is no, and this is actually going to show up in one of our trade ideas, two of our trade ideas here into the afternoon, or the end of the video, I should say. What else do we see in the sector? sectors, XLB, the lightest weight sector, plenty of room for a higher low in this zone here. Mild pullback. It's a little bit more aggressive. We certainly have an hourly downtrend out of materials relative to the tech sector and financials even, which are more balanced. So plenty okay with setting a higher low anywhere over 8130. Something that looks like this, I would be back on the bull horse. It's not going to make or break the market one way or another. Let's move into real estate, another lightweight sector, plenty of room for a pullback over 41, keeps us bullish. If we look at energy, no breakout through the top end of this range into its previous larger range up here. This continues to stoke a little bit of concern on the recession narrative, noting that crude as well is setting up for a potential lower high coming into equal lows. You know, the classic pattern there, if you were to just extend this, is a descending triangle, which typically in a downtrend does lead to lower prices. We'll see. But I think that this has much more to do with our recession narrative, which we'll talk more about as we get into Jerome Powell and the Fed and everything that unfolded today. So we look at the XLY. It's a almost picture perfect inverted man ray, left, double head, and possible right. As long as we're over 192.75, it looks fine. I have no qualms with what's going on here out of the XLY. Show me a higher low pullback, show me a hold here. Pattern structure looks great. We'll try to navigate back higher up into the equal high, the neckline of the overall pattern, 205.75. Moving along to the XLP last, but certainly not least, consumer staples stuck in a balance range here. Defensive sector, if it breaks out, great. The rotation thesis continues. If it breaks out as the market pulls back and goes sideways, it's going to dampen the blow that SMH or the XLK or financials or whoever deals the index itself. If those heavier weight sectors pull back, you want the burden to be not lifted entirely, but ease the burden by the XLP, the defensive sectors carrying some of the weight here. That would be up and over 82. So far, just really tight consolidation over the key moving averages with the threat of a breakout through these equal highs. So we'll watch that closely. Let's jump into the ratios on the sectors. If you're not familiar with how to set the ratios up, check out the video tutorial in the top right-hand corner. Green shoots are still shooting. We've got the XLK well above a now flattening out 50 SMA. That's bullish. If we look at the XLF, it's still holding that higher low here over an upward sloping 50 SMA, bullish. XLY could use some work. It's trying to set lows, higher lows, maybe a higher low, but you're also somewhat in range compression with a small lower high here as well. You would ideally like to see some pick-me-up out of XLY discretionary. This is D for defensive, not concerned that it's in a downtrend here. These are defensive too, and we would actually prefer that they do roll over into downtrends to indicate much more of a risk on rotation. They're getting there. There's certainly room for lower highs to persist. Let's take a look at some specialized ratios here as we get a little bit more granular. Green shoots look good. Green shoots look good still. Still looks good here. Still certainly looks good here. So no major concerns out of these. I would say the best thing that could happen up next for this specific dashboard here would be a higher high out of the XLY-XLP relationship. ARC-K also got a little bit beat up here on the rollover, so it's all about setting a major higher low and testing this as soon as possible, in which case this minor inverted head and shoulders turns into a major inverted head and shoulders, and over the highs would certainly be screaming, hey, let's get this party started on the risk on side. Let's jump into the B set, and what we'll see here is actually quite telling. I do want to look at gold. Before we'll look at gold in isolation because this lower high is substantial, as gold itself is actually making much more of, not a full equal high, but much more of an equal high on par in the price chart. We'll get to that in just a moment. But Bitcoin, certainly bullish here, still holding over the 92,000 handle. The Sailor Shift tool is still over the zero mark here, signaling a bullish rotation. And if we look at the TLT ratio to the S&P, the breakdown is still in force, and there's plenty of room, right, for a lower high underneath this previous set of lows. That would be a bullish and risk on rotation. Let's take a look at that gold chart in isolation, though, before we get into currencies and rates. This is what I was talking about. Notice how this is much more of an equal high relative to the ratio chart. This is GLD ratio to the S&P, right? Much more of a lower high. So what does that indicate? Well, gold is technically not going on to outperform or be as defensively seen as it was as the S&P was clearly moving lower through all of this nonsense back here. Both gold and the index are moving higher, which as that's happening, one of them might be lying, but it is possible that both can move up over the span of time. There's nothing wrong with that. It's really when they're massively divergent that you read into it as being like, okay, this is confirming flight to safety, right? So that's gold. Let's move into currencies and rates. Dollar is pretty stable down here, so you're not getting dollar devaluation, which is driving gold higher. It's more of a natural move out of gold. If you're looking at interest rates, mildly lower on the session, but once again, it's the stability in this zone and not the, oh God, we're under 4%, we're cracking 4.5%, we're back at 4.2%. If you keep rates stable, that'll give investors more confidence to dip their toes back into markets here. Let's take a look at the inverted ZT just to get a sense of what the 2-year did today. It's pretty flat. which is no surprise considering that Jerome Powell held rates steady. Let's have our fundamental conversation here. I want to start with our Fed statement tracker. This is the strike-through version. You can get this from the Wall Street Journal. But this line right here, this addition of this green line right here is what we need to focus on, because this is really what the press conference was all about. The committee is attentive to risks to both sides of its dual mandate and judges, this is important, this is the addition, and judges that the risks of higher unemployment and higher inflation have both risen. That is not good. That is an indication of the possibility for stagflation. Now, Jerome Powell did not use that word in particular during his press conference today. However, he did tell us basically that if you want to look back, you could maybe use 2024 as a playbook, right? Maybe you could use that. This line up here is somewhat important. Just tells us that the Fed is looking through the first Q1 GDP, the initial read of the data there, and they're going to be looking for revisions, right? Swinging net exports, which is basically all the imports that cause the drag on GDP. The Fed's looking through that. Okay, so that's what that first line means. But this is far more important. So let's start to break this down just a little bit. What would the Fed deem as unacceptable higher unemployment or higher inflation? Well, let's have a look. Let's take a look over here. So we can see that the unemployment rate that they've projected, this, by the way, is the SEP that they released in March, right? We'll get a new one in June. So the unemployment rate that they've outlined for the year is 4.4. We just got 4.2 last Friday. So we're not there yet. It's probably going to take deterioration in the labor market if the Fed's going to respond. PCE inflation, core, let's stick with core here year over year, they're forecasting a 2.8. The previous read was a 2.6. So we're not really having to keep rates higher for longer to battle inflation, but we know that the tariff shock is potentially what they're keeping rates higher for, to determine whether or not they should adjust when we see the data come in. If you listen to Jerome Powell today, he basically said, as he always does, you should never expect anything different, but you really got to parse out his comments if you want to learn something from him. But the gist, generally speaking, is always, we're going to kick the can down the road, and when the data changes, we'll change our tone, right? We're data dependent. So if that's what you take away from it, that's fine. But if you want to read into the details a little bit deeper, if you are Fed Watch and interested in that, let's take a look back over at the platform actually. And I just want to show you a little bit of the sort of narrative that we could use, the template actually, if you will, for when Jerome Powell may actually be willing to respond to higher unemployment, right? So he said, if you look back at the end of 2024, really August of 24 is when we got those rate cuts, right? You could see the 100 basis points of easing that happened over here. That came on an aggressive uptick in what was going on with the unemployment rate. So let me zoom in and make all of these zooms just about equal, so we're looking at parity across the data boxes, and don't worry if you don't know what's on the screen right now, I will explain it in just a second. So in the top box, we have the Fed funds rate. This is the effective overnight rate, right? You can see here, this is the PCE, year over year count, and so 26 is just a 2.6 on the headline number, right? And this is the unemployment rate down here. And this 4.2 is exactly what we got last Friday. So Jerome Powell said, if you look back at when we actually cut rates, we were cutting rates because we had made substantial progress on inflation, coming down from 5%, 5.5% that we had there. But the labor market was starting to deteriorate. If you were tuning into and listening to his press conference, we covered it live here on the channel, what he had said is that the labor market started a clear trend where month over month it was ratcheting higher. I think you could go back and watch the stream. He made a ratcheting effect. He was like, chick, 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 higher, higher, higher. He did that, literally. And what he's referring to is this time period right here, where the unemployment rate basically went from a 3.4 to about a 4.2, right? And to stop this trend, they cut rates by 100 basis points. And what he said was, okay, we've done that such that we can make it very clear to the market, right? That yes, we care about inflation, but we also care about the labor market. We care about that maximum employment part of our dual mandate, and we're not just going to let the American people hang out to dry as the unemployment rate starts to tick higher. We need to put an end to this uptrend. So they cut rates. So what I would forecast here is if the Fed starts to see prints on the, maybe this is a long-winded way to say, if we go back to the SEP, if the Fed starts to see something like 4.4, 4.5, 4.6, the Fed's probably going to step in and make it very well known that, yeah, we've done a decent job on inflation, but let's not let a new uptrend develop in the unemployment rate. Because as we all know, if we just go back to this dashboard here, I'm going to take a look. Once this trend really starts to get underway and go parabolic, it's very hard to put the genie back in the bottle on the unemployment rate. Think about the negative flywheel that happens. People get laid off, people stop spending, companies make less money on the top line, and how do they save costs? How do they preserve margins to some degree? They lay off more people. Negative flywheel. So that's kind of what we're thinking about, and that's really the main takeaway from the Fed meeting here, which was when the labor reports start coming into the magnitude where we're dealing with something over probably over a 4.5 on the unemployment rate, that's where the Fed's going to feel like, okay, we're going to step in here. And Jerome Powell did make it clear that, don't worry, the Fed will step in at some point when the time is correct. He's just decided that the time is not correct right here, right now. And we're going to look for the totality of the tariff data, which is probably not going to get to us until July, maybe August, September, until we get like 3 months worth of tariff data that starts to roll out, right? We'll get April's data this May. We'll get May, of course, in June, so on and so forth. So it's going to be delayed. I would not be shocked if Jerome Powell is slightly late to the punch there on getting rates slightly lower to preserve a labor market, if that's his ultimate intent. As we take a look at the Fed tracker tool here, now that that's over, we could say that the Fed is currently at 80% odds to pause again in the next June meeting, which I think is aligned with what we heard from Powell today. Once again, I was expecting a little bit more dovish commentary, like, yeah, we're open to it, and sort of the telegraph of the rate cut, but nope, did not happen there. Let's take a look at the earnings calendar. Nothing really after the close that captures my attention other than ARM here today. I think before the open tomorrow, Shopify will be a big deal, as will Coinbase be after the close on Thursday. With that, let's get back on over to the platform. Let's finish up our analysis on the technical front. Bonds relative to themselves still signaling here higher on the long end, right? The market is concerned about that inflation word, but in the short term, right, it does seem reasonable that the market is expecting the end of the hiking cycle. It certainly would seem that rates are not going higher, and it's just a matter of when the next rate cut is going to come, be it June or be it further out July. Let's take a look at, let's go down here to credit spreads. You can see that we're still underneath on the SHY-HYG. This is helpful, but still just in the range out of the LQD IEF spread. Again, these are proxies, but generally speaking, this wants to break down, give you a little bit more confidence and further upside, cleaner upside, you would say, in the S&P. If we move along into junk in isolation, this, I mean, it's a shining star. It has been almost every single time. It called the bullish divergence here, getting the breakout, and then it called the bearish divergence. If you made it to this point in the video in the Saturday update, then, I mean, kudos to you. This is exactly what we were talking about, played out beautifully. As we move along to perhaps, we've already looked at Bitcoin, so let's look at breadth. Breadth is kind of stagnant on the week, which makes sense as we've gone sideways. We really haven't done anything impressive over the Monday, Tuesday, Wednesday sessions here. So not an issue. I would say if breadth was rapidly deteriorating as we were going sideways and there was a divergence, yeah, red flag, sound the alarm bell, but it's just not the case as of right now. You can see the same thing in like the RSP, for example, just hanging out near this area. Is it possible it pulls back? Yes, it aligns with the idea that the S&P weighted could still offer a higher low here anyhow. If we move along into volatility, Vol mildly moved lower today, still technically a higher low. I would think that now that the Fed is in the rearview mirror, we could probably see this tick lower again. Something that actually we didn't look at over on the economic calendar. Where is that? Do we even have that up? We don't. On the economic calendar, we do get the jobless claims tomorrow morning. I would be curious to see what the continuing claims look like out of that. As a matter of fact, let's pull that up here. It's important enough to bring up. So let's go tradingeconomics.com, use their calendar because they parse it out. We don't want previous week, but we want this week, and we want Thursday. What I want to highlight for you is this number right here. So continuing jobless claims. This will be a big deal because last week it actually missed and started to break out to the upside. If we take a look at the chart here, let's use a line chart. It'll make it a little easier to see. Let's go here and this. So you can see if this is a range, right? Last week, we certainly broke out on the continuing jobless claims. It's not really what aligns with what Jerome Powell spoke about today. Obviously, the report we got early May is reflective of April, but the current data in hand is likely deteriorating to some degree. Anyhow, that could be, as we go back to the VIX, it could be one of the elements keeping volatility slightly on edge here. If we take a look at the VVIX, volatility of volatility, and continue to get a little bit deeper into the weeds here. This is a fake upper wick. Don't get too concerned and hung up about that. You would ideally like to see this come back down under its or into its comfort zone, closer to the 85 handle, 75 handle. Down here, you'd be much more confident about a continued trend in the market. If it starts to spike again over 120, that's the concern. Let's move into our vol futures, which still have not reached a technical contango. You do have it here in the 9 versus 30-day VIX. However, in the volatility futures, you're still in that backwardation. And I think the only way, oh, there we go. One of them starting to get a little bit better. We could see this maybe a little bit more cleanly over here. Let's jump into, oops, where are we going? We want the VIX. VIX. There we go. As you take a look at this, right, you've got yourself, oops. This is that little backward contango that we just pointed out. But other than that, the curve is still offering, more risk in the present day still than an unknown future December 25th towards the end of the year. So you would like to see this get into a backwardation, contango, to again be that final shoe to drop and say all clear. Let's see if we can't get this thing moving along in the upward direction. So back to the charts just so you can see it. That's the very, very most dim gray line is in a small contango there. Everything else still in backwardation. 1-day VIX, as we've said, has been a key component of this market recently. So higher on the FOMC, I'm sure, but into the end of the week, if it moves and takes out to make a new low under 1275, that would be a big boon for the buyers at this point in time. Let's move on over into our charts here and get into the core list of companies. 3 trade ideas for you, and then we're on our way on this lovely Wednesday, fun-filled day with the Fed. Looking at NVIDIA, strong close here. One of the stronger closes we have across the market, clearly breaking out of its balance range there. So as we walk forward, and this is due to the end-of-day spike, right? If you take a look, there it is. So what we would be watching for, what I'll be watching for at least into the open on Thursdays, where do we open, first of all, relative to 115.25? If we open under, then this is sort of a rejection, and I would play cautiously in here. I think the biggest short trade is just a cleaner move, either underneath 112.65 to close the gap or waiting patiently for the gap to actually be in play when we get their gap fill reversal for a daily high or low. That's if we open under 115.25, right? So you could, if you want to be quick draw McGraw, be my guest. I don't think this is a very lucrative trade, but you could try to fade the top of the range for risk reward like this. Personally, if we open in range, I would be very, very reluctant to long this. I even would be reluctant to short it if we're in the range. I would wait for a break at minimum underneath 112.65. Get me out of this nonsense zone. Get me out of the meat grinder. Show me some cleaner action in NVIDIA. If we open over 115.25, which is currently the case. You can see post-market we're trading 116.40s, give or take, so right around in here. If we open above, there's 2 outcomes, right? Either you pull back and we can find longs off of this for risk reward to the previous day's high, ballooning runners into 121, or you wait for the Brigade Bolt. If you open in range, right, you wait for the Brigade Bolt over prior day's high, and then you get your continuation here for risk and reward into that 121. So that's really how I'm looking to trade NVIDIA into the end of the week based on these levels, based on the daily chart starting to get a little bit more love up and over the top of the 90-day pause. If sellers are really going to make something happen, I would need to see a almost full reversal underneath 104.75 to take away some of the progress that's been made based on this development of the uptrend. Lows, higher lows, and higher lows, right? Let's move along to Microsoft. Pretty weird day. Not really getting follow through underneath. I think the hourly chart does it the most justice, but this is a gap from earnings. This is a gap from earnings. We're waiting for some better structure to build out. We definitely just have a balance up here. Here it is on the hourly. And you can see, let me see if I can't make that front and center. There we go. There's just nothing to do. If you're in this range, you can try the Brigade Bolts underneath. This morning we tried that. It kind of didn't work, obviously. So if we do get it again, maybe an hourly close underneath, 15-minute bearish 3-bar plays underneath 432.50 could be it. Something with a little bit more conviction underneath the level. It would definitely be helpful if the broad market was also falling apart if we're looking for that short. And the target, of course, is just going to be, I know that's such a funky zoom, back to the low of the earnings gap up day, which is around 424.50s, give or take. Then, it's a different story when and if we start approaching the earnings gap under 423. We'll take that one step at a time. 423, what am I even saying? It's technically above that. The earnings gap exists from here all the way to there, but 423 comes from, back on the daily, this gap from back here, right? So too many gaps. Too many gaps, hashtag too technical. If you remember what too technical is from, let me know in the comments section. Hashtag too technical. Apple, it's one of the concerning charts out there. The reason I say that is because it clearly failed underneath the 90-day pause high. It failed underneath the electronics tariffs pullback low, which is this zone as well. It's the same level, 201 basically. So the failure of Apple to hold up here is going to provide some drag on the market. It would definitely be more compelling on the long side for the S&P if some of these heavyweight components were also suggesting very clean higher lows over something like your 201. And honestly, we had that look with the hammer on Friday of last last week. It's just that the market got no follow through over that hammer high to suggest the hold of the higher low over the key level, and it's been sort of just a slow dribble lower ever since then. So Apple's kind of a threat from that perspective here. Any lower highs under 201, you're just sort of dealing with, maybe you call this a balance area, lows equal lows, lower high happening from here to here. Maybe it's a little head and shoulders-esque. Your better flush would certainly be set the lower high, break this, equal lows would be the target. It's a little extreme calling for the same amount of volatility and downside as the tariff lows, but that would be the structure. So Apple's a concern. Moving along to Amazon. Nancy kind of held up fine today. It's just inside of this range. There was morning pullback was really strong, actually. If I go to a 5-minute chart, you can see this. I didn't have the level mapped because I was not fond of Amazon doing this and then this, so I didn't have the level on there. But this morning pullback here went straight to the hourly level. This is a new level that we have on there based on today's lows of the consolidation. But point being is that Amazon, did make a strong move on today's session. If we go back to the hourly, what does that leave us with for the remainder of the week? I would think that it's possible if Amazon buyers step back in as they did today, I would want to be looking for long exposure over 189.25 to test again the daily 50 as well as this 192.25. If Amazon opens in this midpoint, no touch, and then underneath, I would still be a little bit cautious of shorting Amazon underneath this. I don't think that it's a clear-cut short here based on the momentum we saw this morning. For shorts, got to see something like this underneath the 183.50. That's Nancy. Let's move along to Google. Another abysmal day for Google, and obviously the release here is the Apple integrating AI into their search bar or their Safari, I'm sure. So what does it leave us with out of Google? Well, this is certainly a bearish engulfer. Let's remember that this has basically taken out 11 trading days of uptrend here in one fell swoop to the downside. And honestly, intraday, if you were to look, again, I'll bring up the 5-minute chart because why not? If you look at the 5-minute, there was honestly, maybe the 2 minutes even better. There's a little lower high that formed right around in here, that bar right there. So generally, the bears are making it happen. There was no buyer to step up at 157 to hold up inside of this range to preserve the daily uptrend with lows, higher lows. Ideally, higher lows stayed here, right? So that's not the case. The bearish engulfer certainly changes the tone out of Google as a heavier weight component in the S&P 500. As we acknowledged in the intro, that's certainly a threat that we need to contend with into the end of the week. So rallies that reject 157 tell you quite a bit about the state of affairs in Google. A rejection there would be not all that strong for the long bull thesis on the S&P. So watching that, if it does recapture it fairly quickly, I'd be a little bit more relieved, so to speak, in the S&P. So first thought is that the bears do have something going on here. We'll see if it can stick or not. Let's move along to Meta. And make note that we have a balance range here. So very simple trades to be looking for. We have either underneath 586 to test the top of the gap and Brigade bolt into the gap, 571, 549.25. We have consolidation here. And then we have Brigade bolt over the top end of the range. Very simple, right? 607.25, 635.25. If we look at the hourly time scale, oops, we don't want that. We want hourly time scale. Where am I going? Here it is. You can see the balance. So is there anything to do if we're just noodling around in here? No. Is there maybe a little bit more of a bullish edge if you get this to finish up the week? Perhaps, but I would really wait for those daily zones for the cleaner trade. 607.25, 586 flat. Let's get into Tesla, another problem child, in my view at least, for the market. Reason I say that is it's had a number of opportunities here to suggest buyers, or give the buyers basically the opportunity to step up at the bottom end of the flag range, right? If this is a bull flag and this is a daily double bottom, the neckline break is pretty critical at this point, and buyers are just unable to really, or there's no momentum here off the lows. Buyers are not stepping up off of these lows. Now, I'm not going to preemptively short this and just say, okay, that's it, it's failed, it's got to go to zero. It's not the point. The point of the conversation is just to say, as we go back down, this is still on a 5-minute chart, which is fairly convenient. As we look at the morning session, this, where is it? Here is the morning session open here. This little 5-minute hammer that came below and then got back above the prior day's key inflection point, the fact that that could not materialize, and if you even take it a smaller time frame to like the 2-minute, this is where I was looking at it this morning. If you're looking at this, there was a little 2-minute flag that started to form at the opening print, slightly above the opening print. This is JD Vance coming out, and I don't even know what he said, but it caused a lot of turmoil across the broad market in entirety. From there, it just failed the setup, right? There was no higher high. We were coming from the lowest low. Just nothing here. There was no pullback for a higher low here to get back over the 276. So a little bit less thrilled with the Tesla action over today's session towards the bottom end of the range, just not finding buyers. You can see how sideways it is down here versus in the past, V-shaped recovery off the lows, straight to the highs, right? This, even a little bit of a stronger response into the end, the Monday session off of these lows. So Tesla seems to me to be a little bit more concerning. Buyers tired here. And if it were to break the range, again, I'm not preemptively jumping the gun here, but if it does, under 270, 250, you've got thin structure back down into 260. Now, when we get here, is it worth looking for a potential reversal back to the upside? Sure, but you're just not getting a daily bull flag breakout like the original pattern was perhaps suggesting towards the top end back here. Let's jump into JP Morgan, see what's going on from this perspective. Financials, plenty of room for a higher low here, close the gap, 246.50. We saw the XLF chart looks fine. Back-to-back inverted hammers, looks a little bit heavy. I wouldn't be afraid of a pullback here, so looking for that higher low. Netflix, one of the strongest names in the market right now, just straight back to all-time highs. Beautiful hourly chart here. Great for investors, and I'm happy to have some Netflix long exposure, not a ton, some. The chart pattern is beautiful, excuse me, but the spreads on the options here, anybody who traded Netflix options, that's like $1.50 wide on $14.50 by $16 or something like that. It's a little, I don't want to say it's untradeable on the options front, but the liquidity's not great. It's spready. You got to be using limit orders there half the time. I feel like I'm not even getting filled on some of this stuff. So Netflix, will take it with a grain of salt, but the pattern is, the structure is undoubtedly bullish. If we can get into new all-time highs, that would just be over 1160. All right, I've got it's really 2.5 trade ideas for you. Let's start with the two that are very similar. Let's go ABBV to begin with. ABBV, of course, is the ticker there. Earnings are in the rearview mirror, which is helpful. And notice the bearish 3-bar play here underneath the daily 200 SMA. We just talked about how the XLV healthcare sector is technically weak, right? It's inside of its range. Notice that we have thin structure through this lower wick, as well as some of this volatility from the tariff turmoil. Underneath the low at 186.75, breaking the 3-bar play should bring us closer to the neckline of this double bottom reversal for a retest at 180.25. Take a look on the hourly time scale. You can see the lower high that's here. I would honestly say as long as lower highs can persist, let's get the click there. As long as lower highs, come on, work with me. As long as lower highs can persist under 191.50, let's perhaps make this gray and dotted just to dim it back a little bit. As long as this persists as overhead supply, I would still be thinking about this setup here over time, right? Thin structure would go straight down, go straight up, can probably come straight back down under that 186.75 into 180.25. In the same vein as this is Eli Lilly. So LLY is the ticker there. If we take a look on the daily time scale first, there's your bearish 3-bar play. What perhaps makes this a little bit more attractive is just the fact that there is still some gap there on the chart. So if you're under 770, the gap closes into 757, and this would persist as long as the lower highs remain underneath 796.50. So same concept, slightly higher price point, much different options on the spread at least, but this lower high, right, gap closes ultimately the target. If you could short the lower high there and get this, then fantastic. If you could look for the intraday scalp, something that looks like this, then fantastic as well. But that's Eli Lilly and AbbVie, two bearish ideas in healthcare. Then we have Palantir, big bad Palantir, making a stand at 107.75. On the hourly time scale, it's really easy to see, so let's just leave it here for a second. This prior pivot high, which led to some further downside before the consolidation. And remember that Palantir remained rock solid through all of the tariff turmoil back here, right? The fact that post-earnings it gaps down and it's holding this level for a potential higher low at 107.75, I love that. I absolutely love that. So could this be seen as a double bottom? Sure, over the neckline, 111.75, into the gap over 114. These are definitely locations. These are areas where I would start thinking about upside risk for some sort of gap close on the earnings front. So as long as price is over 107.75, thinking about this playing out as a daily higher low opportunity. Now, if price breaks underneath 107.75, it's a different story, and maybe the pullback continues. The next major spot I would look for is the 97.55, coming from these prior highs right back over here. This is more of a mild level. If anything, I should do this and probably dim that back just to do it together. 102.25 has been dimmed back. All right, so that's that. That is what we have in today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section, or simply give the video a thumbs up. It goes a long way to support the channel, and I certainly appreciate that. We will be live tomorrow morning, as we always are, every morning at 8 o'clock Eastern Time for another episode of the Pre-Market Prep, giving you a game plan. We can look at how the moves have unfolded overnight, and we can continue to expand upon the thoughts and the trade setups that we covered in today's episode. I hope to see you there. With that said, have a green trading week, and I will see you in the next one.